Man, I'm glad I don't have to be out there right now. Hi, my name is Sylvan J. Raman. Welcome back to Intentional Wealth. In today's video, we're going to talk about, is the 20% down payment for mortgages dead? Well, before we get into that topic, do me a favor, subscribe to the channel, click the bell icon to get notified every time we release new content. So what does 20% down payment mean, first of all? Well, it basically means that when you go out to get a mortgage to buy a house, you're gonna put 20% of that purchase price down as down payment. And you're gonna finance that 80% of principal. Now, what you're gonna do is with that 80% is you're gonna pay it over a set period of time, usually 30 years or 360 months. And you're gonna pay that over an interest rate. Usually, it's best to keep that interest rate at a fixed rate and not a variable rate. So 20% down payment used to be the rule that you had to have 20% to do a mortgage or to get a mortgage on a home. But recent past, it's been possible with state programs and bank programs to actually get mortgages with less down payment. In South Dakota, for instance, there is a state program where you can get a mortgage on a personal home with zero down. That means you can finance the full amount of the purchase price. Wow. You have to pay closing fees and closing costs and stuff like that, but those are minor compared to the amount that you're financing. When it comes to a personal property, I totally believe that you should put as much down payment as you can so that you can pay a lower mortgage amount. And I like to pay a lower mortgage amount because things happen in life, things come up. Even if you're good at saving and stuff like that and good with your finances, things always come up and you don't know what you need that money for. Also, with having a higher down payment, you usually get a lower interest rate depending on your credit score. If your credit score is over, I believe, a 720, you're gonna get the best interest rates for the most amount of money you put down. But right now, in today's market, the problem is 20% down payment can actually be a big amount, and it's very hard for people to actually come up with 20%. So what do? You go shop around for mortgages that are actually less than 20%. The issue with paying less than 20% down is you're gonna have another cost associated with that, and that's called private mortgage insurance, or PMI. You're gonna pay PMI, which is basically insurance stating for the bank that if the home buyer stops paying their mortgage, that insurance is gonna kind of offset that, or let's say foreclosure problems and stuff like that. Now the thing is, even if you do put a lower down payment down on a property, that doesn't mean that you're gonna pay PMI forever. Usually once you hit 20% equity, you can actually ask the bank to remove the PMI, but once you actually hit 22% equity, that means the bank will actually take it off automatically and you'll stop paying PMI. So now you know that I would rather put as much money down as I can, whether it's 20% or even a little closer to 20%, but not quite 20%. And that's just my personal aspect of it. I like to have equity in my personal property in case of a rainy day. Also, that means I'll have a lower mortgage payment. But the thing is, right now, with the market being the way it is, like I said before, it's hard to get that. And there is another school of thought that if you actually wait to save 20% down payment for a home, let's say you have a $300,000 home and you have to save 20%. That means you're gonna be saving about $60,000 for a down payment, and that is difficult for a lot of people. But on the flip side, if you're able to get a mortgage with less down payment, let's say 3%, which is actually possible, you're only gonna have to save $9,000. Yes, your mortgage payment is gonna be higher, your interest rate might be a little higher, and you're gonna be paying PMI. But like I said before, PMI eventually comes off and you can ask for it to come off earlier instead of waiting for it to get automatically canceled. Now, the reason a lot of people think you should go ahead and get a lower down payment mortgage instead of waiting to save 20% and then buying a house is because of this thing called appreciation. In the last few years, real estate has been really appreciating in certain markets. especially bigger cities and stuff like that. So the theory behind this is that if you can actually put a lower down payment down and afford the higher payments monthly for a mortgage, you're actually going to be building appreciation. Now, there's one side of me that I don't believe in buying a property for appreciation. I never buy an investment property based on appreciation. A lot of people did that before the market crash, and right when the market crash happened, all the prices dropped. I don't buy things on what they're going to be valued tomorrow or what they're going to be valued next year. That's just not something I do in my investment. And actually, in buying investment properties, you actually make money when you buy the property, not when you're going to sell it. So most of your profit is made in the way you buy it. But I digress. We're talking about personal homes, not investment properties. To give you an example of the other side's theory of putting a lower down payment is this. I have a friend that bought a condo, a 2-bedroom, 2-bath in New Jersey. When they bought the condo, it was $300,000. They put 3% down, meaning $9,000, and they had a higher mortgage payment. They do pay PMI. But over the last 10 years, their condo has appreciated on basically $30,000 on average per year. Today, their condo is worth $600,000. And that's because of real estate prices getting crazy, right? Now imagine if that person had to wait to buy that condo with a traditional 20% down payment mortgage. I don't know if they would have been able to buy it at any point because prices were going up so fast every year that it kind of didn't make sense. Now, the issue that I have with buying with a lower down payment, and if you're looking at appreciation, is you have to know your local market. Is your local market really appreciating so fast? Just yesterday, I heard that Nashville, Tennessee is actually a hot market right now for first-time home buyers or new home buyers. With everything going on in Nashville, Tennessee right now, real estate prices are getting higher year after year. And so buying for an equity type position with a lower down payment might make sense in a place like Nashville. In other rural areas where you think real estate might go high or get higher, I would not do it. Like I would not buy something in Michigan based on appreciation compared to buying something in downtown Chicago based on appreciation. So for me personally, I have chosen not to buy right now. I'm going to continue to rent at least for the foreseeable future, at least another 6 months to a year. Now, if for some reason there is a great opportunity that comes up where there's maybe a lower down payment, built-in equity, I get the deal right, then I might go ahead and buy a condo out here in downtown Chicago. But until that happens, I'm perfectly fine with renting and investing my money in real estate properties or investment projects that bring me a better return. One thing that I didn't mention in last week's video when we were talking about home buying versus renting is that the reason I'm investing in rental properties is all about cash flow. Once I have enough rental properties to basically cash flow my life, then what I'll do is start buying the things I want to buy while still investing. Right now, I'm just investing for cash flow until I can replace all my bills, all my lifestyle needs with that cash flow. And I'll keep investing, but right now, it's all about living my life. One thing I'm a big fan of, whether it's an investment property or a personal property, is to pay off the mortgage faster, or any type of note that you've taken on that property. Even with the property that I bought for $20,000 down, eventually once we get our project that we have planned for that property up and running, we're actually going to pay the note down faster. Because see, what I'd rather do, and this is unconventional thinking in the real estate world where everybody is about leveraging debt. Look, I love leveraging debt also, but I also like to be safe and conservative with my money. You know, until we're at a point where we can take bigger risks. I like to pay down my mortgage. So if you're going to buy a house with a lower down payment and you have a PMI, do something about paying down that mortgage faster. If you're affording this house and barely scraping by or not saving that much, or you're not putting much into a retirement account, or investing it in other places, then you probably better think twice about buying a home. And stay tuned in next week's video where we're gonna cover some ways where you can pay off your home faster. This nasty weather aside, if you've liked what you've seen and heard here today, then please do me a favor, subscribe to the channel, like and share the video, click the bell icon so you're notified every time new content is uploaded, and do me a favor and follow me on Facebook, Twitter, and Instagram. And we'll see you next week when we talk about ways to pay off your mortgage faster. Action. No, I just saw a text Nancy sent me.